1. UK unemployment hits four-year high, what it means for interest rates and your money. 2. UK jobs market cooling, unemployment up but not collapsing. 1. UK unemployment hits four-year high, what it means for interest rates and your money. A four-year peak in unemployment, a double-edged sword for interest rates. In a surprising turn of events, the United Kingdom's joblessness rate has surged to its highest point in 4 years, igniting a debate on whether this development will prompt a cut in interest rates by the Bank of England. According to the Office for National Statistics, ONS, the unemployment rate climbed from 4.6% to 4.7% during the 3 months leading up to May. This unexpected increase, following a 0.1 percentage point rise last month, was not anticipated by analysts. The ONS data, however, comes with a disclaimer due to low participation rates, which may affect its accuracy. Wage growth has also shown signs of deceleration, with average weekly earnings increasing by 5%, a slight dip from the 5.2% reported the previous month. This decrease might seem insignificant, but it plays a crucial role in the broader economic landscape. Liz McEwen, the ONS's Director of Economic Statistics, commented, "The labor market continues to weaken, with a decline in the number of employees on payroll, although revised tax data indicates that the recent month's downturn is less severe than initially estimated." McEwen further noted that pay growth has fallen in both nominal and real terms, but both metrics remain robust when compared to historical standards. She added, "The number of job vacancies is still on the decline, marking a continuous 3-year fall." Amidst this backdrop, the ONS released data revealing a surprise increase in inflation to 3.6%, complicating the Bank of England's decision-making process regarding interest rate adjustments. Despite this, a quarter-point reduction to 4% is widely anticipated at the upcoming rate-setting committee meeting in early August. Experts believe that the bank will look beyond the headline inflation figures and consider the softening labor market observed in 2025, a factor that Governor Andrew Bailey recently emphasized in an interview with The Times. Weaker pay raises are essential to lowering borrowing costs, given concerns that the UK's struggle to curb inflation is partially due to wage growth outpacing price increases since August 2023. Coupled with the slowdown in economic growth, this scenario resembles stagflation, characterized by weak growth and persistently high inflation, far exceeding the bank's 2% target. While conflicting factors influence the bank's interest rate deliberations, rising inflation, weakening growth, and jobs data are all detrimental to a chancellor under mounting pressure. Chancellor Rachel Reeves faced criticism on Wednesday for exacerbating inflation through employment taxes implemented in April. Industry bodies in the grocery sector argue that part of the rising food prices can be attributed to businesses passing on the additional costs, along with increases in minimum wage requirements. These budgetary measures have evidently restrained hiring since the spring. Frasers Group, the parent company of Sports Direct, reported in its latest results that it is grappling with £50 million in budget-linked expenses and is exploring AI-driven efficiencies to mitigate some of the financial burden. For Ms. Reeves, the likelihood of an interest rate cut next month remains intact, which would alleviate the cost of servicing government debt. Her fiscal headroom within the public finances is under severe strain, with government reversals on winter fuel payment restrictions and welfare reforms squeezing her budget. To address potential shortfalls, she may need to resort to additional tax hikes or spending cuts in the upcoming autumn budget. Yael Selfin, chief economist at KPMG UK, weighed in on the prospects of a rate cut. The slowing activity in the labour market, combined with easing pay pressures, will likely lead the Bank of England to reduce interest rates next month. The impact of the tax and administrative changes in April has significantly slowed hiring among firms. With domestic activity remaining sluggish, the Monetary Policy Committee, MPC, will likely seek to support the economy through a looser monetary policy to avert a more severe deterioration in the labour market. Stay tuned for updates on how this evolving situation will impact the UK's economic landscape and the Bank of England's monetary policy decisions. 2. UK jobs market cooling, unemployment up but not collapsing. The recent uptick in unemployment rates indicates that the job market in the UK is experiencing a cooling phase, yet it is far from a total collapse. With sluggish economic growth, increasing inflation, and a deteriorating job market outlook, the situation appears grim. If the legacy left by the Conservative government was troubling, the circumstances a year into the Labour government's tenure do not seem significantly improved. Recent statistics reveal that unemployment rose to 4.7% in May, marking the highest level in 4 years. Simultaneously, wage growth has decelerated for the third month in a row, and employers are scaling back their hiring efforts. Given the mix of economic challenges confronting Britain, a slowdown in the labour market is hardly unexpected. Employers are grappling with rising costs due to inflation, tax increases, and high interest rates. Meanwhile, consumers, feeling the pinch, are hesitant to spend, and the ongoing trade wars initiated by Donald Trump are further obscuring the economic outlook. However, it would be misleading to label the slowdown in the job market as a complete surrender. Despite the evident pressures, wage growth remains surprisingly strong, and while redundancy rates are elevated, they are not skyrocketing. Michael Stoll, managing director at Manpower Group UK, stated, "From our perspective, it is holding quite steady given the circumstances." Even with the rise in inflation and negative economic growth in the UK, there are signs of returning confidence. Business organisations have voiced their concerns since Rachel Reeves's autumn budget, arguing that her £25 billion increase in employer national insurance contributions and a 6.7% hike in the national living wage would compel them to reduce jobs and increase prices for consumers. While it is common for business leaders to amplify such worries to gain a lobbying edge, this time, the evidence suggests a tangible impact from the Chancellor's tax-raising policies. Recent data indicated that inflation surged more than anticipated in June, as businesses passed on the increased employment costs to consumers through higher prices for meals, hotel stays, and groceries. Additionally, the latest figures show a concerning drop of 41,000 in the number of workers on company payrolls in June. Job vacancies are declining most sharply in sectors most vulnerable to rising costs, such as hospitality and retail. There are also growing concerns that companies are opting for artificial intelligence over human employees. Nevertheless, the labor market data presents mixed signals. Both unemployment and employment figures have risen simultaneously, partly due to more individuals transitioning out of economic inactivity, when working-age adults are neither employed nor seeking work. However, there are significant doubts regarding the reliability of this data, especially given the well-documented issues at the Office for National Statistics. Reading the 7 a.m. labor market release feels like being served a chaotic meal without any utensils. It is filled with caveats about revisions, poor data collection, and volatility. Yet, a clearer trend emerges when analyzing a broader range of data sources. Despite the cooling job market, workers are still securing relatively strong pay increases. The annual growth in total pay stands at 5%, which, although lower than in recent months, remains well above inflation and significantly stronger than anything observed in the 2010s. This robust wage growth has created challenges for the Bank of England, as it fuels inflationary pressures, jeopardizing further interest rate cuts after 4 reductions in the past year. With inflation currently at 3.6% and expected to drift further from the bank's 2% target in the coming months, Threadneedle Street faces a daunting task at its next monetary policy meeting on August 7. The evidence of a further slowdown in the job market, combined with lackluster economic growth, should tip the scales. Most economists predict that the bank will announce a quarter-point reduction from the current base rate of 4.25%. For the government, a further decrease in borrowing costs would be a welcome relief as they prepare for a challenging autumn budget amid rising speculation about tax increases. While there are hopes for a rebound in household and business confidence, the British job market's cooling, though not collapsing, indicates that there is still much work to be done to improve the country's economic situation. But here's where it gets controversial. Are the measures being taken truly effective, or are they merely band-aids on a larger wound? What do you think? Is the government doing enough to address these issues, or is it time for a more radical approach? Share your thoughts in the comments.